Okay, good afternoon, everyone. My name is Jason Allen Jankovsky, and you're listening to my broadcast on how a losing trader thinks. And first of all, I want to say thanks to everybody. David, thank you for having me, and thanks for everyone for coming. You know, I know that everybody listening has put a lot of time and effort into attempting to get better at their trading. And I know that you're looking for better results. What I'm going to share with you right now might resonate with you on a lot of different levels. And I want to encourage you to open your thinking up, because what I'm going to tell you today is going to change, or has the potential to change, a lot of what you invest your time and effort into. I've listened to thousands of broadcasts on ways to improve your market presence and ways to improve your trading results. And I've presented thousands of broadcasts. And I can tell you that this business is not what you really think it is at first blush. And when you have the ability to open your mind up to new and very stimulating ideas, you might find that you're able to shorten your learning curve a lot faster. And it may mean that you're going to find certain things are not what you think they are. And that's what I want to talk about today. So when we talk about how a losing trader thinks, I'm going to talk about the basics of what it means to be a loser. Now, if you recognize yourself or someone you know while we're talking, that's okay, because we've got solutions to all these issues. And quite frankly, the solutions are not that hard. They're just hard to implement depending on, your own psychology. So that being said, let's go ahead and get to work. First of all, I want to go ahead and mention to everybody that trading in the markets, listen, this is a risk investment. Not everyone is suited to do this. You need to carefully consider if you are personally suitable in light of your tolerance for financial risk, your tolerance for emotional risk. Opinions come and go. Everything we talk about in here is considered an opinion today. It's really important to remember too that opinions, market data, trade discussions, this can change at any time. So what we're going to talk about today is something that you personally need to see in light of your own tolerance for risk. Now, if the regulators are happy, here's what I want to do. I want to tell you a little bit about myself, because I know that there are some people listening that have never heard my name, don't know anything about me. Let's go ahead and start with the basics. I'm self-taught, self-educated trader. I started as a customer in 1986, just like you. I opened an account. Well, I don't know if I can tell you who I opened the account with. Jack Carl in Chicago, Illinois. I'm born and raised from Chicago, Illinois. Worked in the markets from 1987 until when the markets went electronic. And I can tell you without any hesitation at all that this business is not for the faint of heart. If you're interested in really learning how to excel, the smartest thing you could do is study the lives of winning traders. Forget the market study and forget the rest of the study that you might be exposed to over years. Start spending time studying winning traders. That'll shorten your learning curve tremendously. But anyway, I started as a customer in 1986, did my very first trade in Chicago Board of Trade, big board corn. I was hooked. That was it. And I wanted to do this. The problem was, and I still trade my own money every day, every single day. I take the risk that you take every day. Problem was, when in my early years, which is in my book, The Art of the Trade, for those of you that don't know, I'm a published author. I have 4 books published, 3 by Wiley & Sons, 1 on Amazon Kindle right now that you can get. I train and coach other self-directed traders since 1997. But the point I'm making is that in my early years, which I talk about in detail in The Art of the Trade, I got my head handed to me over and over and over again. I got to the point where I thought God himself was out to get me. It was so emotionally devastating to me to lose money year after year after year. And I couldn't figure out what the problem was, because I was doing everything you do. I did the study and analysis and all that stuff, and attended seminars and bought DVDs and videotapes and attended weekend retreats with, really good traders, and still couldn't make any money. And then one day I had the wake up call. One day, my girlfriend, who I was tight with at the time, said, "How much have you spent on all these charts and books and tapes and all this crap?" And I added it up one day and I told her, and I was embarrassed to say I probably spent six figures on that stuff over the years. And I told her, and she said, "How much money have you made?" And I'm embarrassed to say at the time, nothing. And she said, "You should be in the racket around the racket. They don't know any more than you do." That was an eye opener. What is missing? How can I spend all this time and money on a private seminar with, guys I could tell you the names you would recognize, and they read their books and not make more money? Why are they telling me how easy it is, but yet I can't crack this nut? So one day it dawned on me what the problem was. And when that happened to me, I never looked back. And I haven't had a losing year. I can't tell you how. I can't remember the last time I had a losing year. Oh yeah, I'm not lying to you. I'm going to tell you the truth. I have losing days. I have losing weeks. Occasionally a losing month. Even more rare, a losing quarter, which happened Q4 2021. I can't tell you how frustrating that was. But first time in a long time, markets have gotten really crazy. Why is that? What's going on? Well, same thing that's always gone on. It's just how you look at it that makes a difference. I learned that my psychology is the determining thing. And what we're going to talk about today is how losers think, what their psychology is that brings to the table their losses. And then I'm going to show you a way out of that mess if you're interested. And I will tell you right now, the only thing I want you to do is go to my website, take a look at the free sample of my latest book, The Psychology of Trading. If you like it, get a copy. It's the best $10 you'll ever spend, in my opinion. That's all I want you to do. You don't have to do anything else. But if you're really serious about winning, what's holding you back? Well, we're going to talk a little bit about that right now. Oh, before I forget, what I do right now is my focus is to affect your change from studying the markets to how you use the markets. Bottom line is anybody can learn to do this, in my opinion. I don't care who you are, what your background has been like. If you want to win, you can figure out a way out of the mess of losses and start putting some serious coin into your bank account. But that's not going to happen the way you think it's going to happen. And that's where most people have their problem. So let's get to work. First of all, every trader has to learn how to trade, right? So what's about trading becomes so difficult for everybody? Why is it everybody is having their head beat in so much? And I think the trading issue of poor performance is no different than anything else, really. To succeed in anything, you have to learn what is required for that particular skill set. If someone, anyone, doesn't matter who it is, if somebody has succeeded at something, that means it's possible for anyone else to succeed at that. Okay. Maybe we could draw, a parallel here to say, okay, so someone who has suffered, a debilitating accident and no longer has the use of their legs, maybe they can't learn to dance anymore. But that's not the point. The point is, if you got full control of your facilities, that you came into the world with, you want to learn to be a dancer like Fred Astaire? Great. I bet you can learn to do it because other people have learned to do it. It's really an issue of learning to change the things you need to change. If it's important for you to become a winning trader, someone else has done it. Yeah, you could do it too. But what causes someone to lose? Now, that is really as important, if not more important, because if you don't know what causes losses or what causes people to lose, you can't learn what to avoid in your drive for success. And a lot of people do that. They don't know what the problem is because they haven't studied that. They study success, but they haven't studied losses. So they don't understand what the difference is. Now, all losers, now I'm talking about everybody in any field doing anything. These are all people who have failed at something they believe they could have succeeded at. Those people, they share common traits. They share common behaviors. And these similarities are common to every other person as well. In other words, no matter what you and I are really looking for, doesn't matter what it is. There are various similarities between all these people, you, me, and everybody, that can be seen in the results from losing traders. The same thing. We all share the same experience. We get the same issues to get there. Why do you think there's support groups for people recovering from addiction? Because they've all got the same problem, but they don't understand that. They think they're unique. They think their issues are somehow separate. They're not. You have the same problem. I'm not saying you have an addiction problem. I'm saying you have the same problem. You don't know what you don't know. You don't know what the real issue is. And you think the problem isn't you. You think the problem is more study. You think the problem is more information, more understanding, more background, more data. You understand the problem is you. The reason you're losing is because you are the problem. So failure at anything is the same for anyone. Losers fail into markets for the same reasons anyone fails at anything else. They're either ignorant of what is causing their failure, or they are unwilling to make the needed changes required to win. Or maybe a combination of both to some degree. Let me say that again. Losers in the markets are either ignorant of what is causing their failure, or they're unwilling to make the needed changes required to win, or a combination of both. Losing, in a lot of ways, guys, it's a choice. If you're still losing in the markets, that's because you want to, or you think you can't do anything better yet. A proactive individual will see that they need to learn something, whereas a loser doesn't see it that way. A loser makes excuses, justifications. They become confused as to what specifically must change. So what are the similarities between losing traders and everybody else? What is similar? If you're going to lose and be a loser at something, I have a friend who's been divorced 4 times. Do you think the problem might be you? He always marries these wonderful young girls that have got these great, big, beautiful brown eyes that want to love and care for their man, and within a few years, he's divorced. Think it could be you? Oh, I knew you'd take that bitch's side. See, that's his attitude. His whole thinking process is wrong when it comes to having a loving relationship. But you can't tell him that because he's got it all figured out on his own. See, I'm sure you know people like that. Same thing is true with trading. Common traits of losing traders are expressed in the markets as choices and behaviors. Market losers operate with similar methods of thinking as other kinds of failure, and they express that thinking as where and when they buy. This is interesting. Here's something that's really important. Traders tend to think that they have little or no control over their account balance, the net result in their account. And this is extremely important because this is a starting point for losing behavior. You have 100% control over your account balance, 100%. Nobody twists your arm to buy. Nobody twists your arm to sell. Once you're in a trade, nobody tells you where to liquidate except you. Even if you place stops and all the rest of that, you're preordaining a liquidation point or an entry point. You're making that choice. Nobody else is making that choice. You have 100% control over your account balance. Now, losing traders don't think that's true. They have a feeling of low control, and that's the result of their losing thinking. In other words, their losing thinking gives them a feeling of low control, so they got to fix that. Their belief that gaining better control will result in reducing the risk. Every single person listening believes you can reduce the risk by studying, doing certain things differently, making certain choices differently, doing certain things differently when you trade, execute, placing orders. You all believe you can reduce the risk. Losers lose in the marketplace because they think they can reduce the risk. And this focus dominates what they do. But see, I'm going to tell you something that you're probably not going to want to believe, and I'm telling you this is absolute fact. You cannot reduce the risk. It's not physically possible, and I'm going to prove that to you right now. You can't reduce the risk. Your thought is, okay, well, why can't I reduce the risk? Because the markets are always the same 100% of the time, and the risk is not about the markets. The risk is about you. I am amazed. I've been trading for almost 40 years. I've been alive in the markets trading more than some of my clients or customers have been out of the womb. I've made and lost millions of dollars. And I can tell you with absolute certainty, the markets have nothing to do with that. They're incidental. The real reason why people make money or lose money is because of the way they think. It's about you. The markets are a zero-sum transaction. I'm amazed at how many people who are trading today have never heard that term. They don't know what that, even if they have heard that term, they don't know what it means. See, every buy that you place in the market results in a sell from someone else. In other words, if you want to buy the market, you can't do that unless there's a sell order. So how do two reasonably intelligent, sophisticated people with brains in their head, money in their pocket, come to the conclusion by looking at all the same stuff? I talk about this in my book, The Psychology of Trading. It's called The Problem of Shared Data. Is how do we all come to the same equal yet opposite conclusions? How come I can look at, when I'm trading corn, I'm looking at all the same stuff you are. Every corn chart anywhere in the globe looks identical to mine. Mine is the Chicago Board of Trade corn. That's it. Nobody trades any other market but that. The entire globe trades in Chicago. Corn, Board of Trade, right there. That chart is exactly the same for everybody, everywhere in the globe. And everybody has access to the same indicators. They have access to the same studies. They have access to the same crop reports and data. So how do we all look at the same stuff and come to a conclusion that's equal yet opposite? In other words, I look at all this and I go, it's time to buy the market. So I place my buy order. Somebody else looks at all the same stuff and they decide it's time to sell. So they enter a sell order. So my buy order is offset against the sell order. And now I'm long and you're short based on the same information in the same market. Now what happens? Now the market moves in price as the next round of orders comes in. And that means one of us is winning and one of us is losing. So if more buy orders come in than sell orders, the market will rise. And I'll have an open trade profit. You'll have an open trade loss. Now, no one can know what those orders are going to be until they're placed. And no amount of analysis of any kind can predict that, ever. It is not physically possible at this point in technology and human development for us to know how many orders are going to come into the corn market after I buy it and you sell it. Not physically possible. So if you can't know what the orders are going to be, how can you make money? So you can't reduce the risk. I've been trading for almost 40 years and I can do the best study and analysis in the euro that you've ever. I can make people raise from the dead with my study of a euro and still put a losing trade on tomorrow morning. Because you don't know what the orders are going to be. You don't know. You could be wrong about the, look at this last statement here, this last little bit on the screen. Let me get it up here, my cursor. You could be wrong about the order flow coming into the market next. All the study in the world isn't going to solve that problem. You can't reduce the risk, but you think you can. So that's why you're losing. See, think of it this way. The only way you can get paid, this is the only way you can get paid. You cannot make money in a zero-sum transaction market. Forex, futures, options, warrants. You cannot make money in a zero-sum transaction business any other way. This is it. Your profits are paid to your accounts from the accounts held by the losing traders. If you're winning, that means a losing trader is out there somewhere taking their the exchange is taking the money out of their account and putting it into yours. There is no other way to get paid. The loser pays the winner. That's the only way. It's not arguable. We're not going to have a discussion about that, because if you don't understand that, you might as well go stand on a street corner tearing up $100 bills because you're a bigger idiot than you look like. You can't make money in this business unless you're taking it from another trader. You can't make money unless you take the money from a losing trader. You got long corn, he got short, order flow comes in, and the market is larger on the buy side. You're making money, he's losing. That means he's paying you. So how do you make money in this business? You have to know where the loser is. 85% of people trading are losing at any one time. The only thing you need to do is identify where the group of losers are, where they're executing at from where they're executing from at any one particular time. So whatever you're using to study or feel like it gives you an edge, whatever you think is helping you reduce the risk, if that can't help you find the losing trader, you lose. It's a waste of time. If you can't find the losing trader, you lose. Doesn't matter that you studied this using a Cray supercomputer that you bought from the Air Force at a garage sale. Doesn't matter. You're on the wrong side of the order flow, you lose. Want to be a winner? What do you got to do? Find out where the loser is, take the other side of his trade. Now, here are some common thinking traits that become failure in the market, both in the markets and in general. In other words, if you have these issues in your life, it's going to lead to failure sooner or later. Now, I'm going to give you these as loser thinking because what I want you to do is ask yourself if any of these are present in your own thoughts. Because if they are, there's a really good clue why you don't have the money in your account that you could. Yeah, you might be having some winning trades here and there. And you might be making money occasionally. And you might even have a good quarter or two. But if you want to lay it home every week so you can wake up in the morning and make money any day you want, go home at the end of every week, month, year, make money every day, week, month, year as best you can, do it consistently, you got to change something. And these are the things you got to change. Okay. All these are loser thinking patterns. They result in buy-sell choices that attempt to reduce the risk. And we can't reduce the risk. You could be wrong about the order flow tomorrow morning, no matter how smart you are and how good you are, right? This is the market term losers use for gaining better control, reducing the risk, okay? Evaluations, assumptions, misconceptions, illusions, justifications, expectations, exceptions, excuses, blame. Oh, and before I forget, well, we'll just talk about it right now because I only have an hour and I don't want to lose my space. Evaluations. Every losing trader brings to the table this issue as some form of market study. Evaluating the market. What are we doing here? We're trying to figure out what the market's going to do next. And this is what? Technical analysis. Now, I'm not saying technical analysis is bad. Just like I will tell you that, you know, too much garlic in your food is bad. Maybe you like a lot of garlic, you know. But the bottom line is technical analysis can help you win. I do a whole chapter on technical analysis. In all of my books, I have the same kind of information available on technical analysis. It can't help you win. It can't. Now, I know there's people out there that have got great ideas on analysis, and they've got wonderful clues that they think they have, and they've got wonderful statistics. Great. That's good for you if you think that'll help. But in the bottom analysis thing, in the bottom line, technical analysis can help you win. And the reason is because of something called the best way to describe it is a mathematical anomaly or a mathematical fallacy. Now, anybody that's an engineer out there, anybody that is somebody who designs brake pads for a living, somebody who is out there that works with numbers that have to do with cause and effect, change, you know, you can't pump 10,000 pounds of pressure through a 1-inch pipe without the pipe breaking. And why is that? It's not designed for that. Okay, well, how do you know that? Because the numbers tell us that, right? Okay, well, what are the numbers? Well, the numbers are you can't use variable A to predict variable A. I have a book on my shelf. Maybe you've heard of the name, Rene Descartes. He wrote a book called Logic. And in there, he talks about things that cannot be refuted or disputed. And when he talks about that, he talks a lot about math. And math, in fact, our friend Isaac Newton said this too, is that mathematics, he invented calculus, not a dumb guy. He said the rate of change is definable, but the variable of change cannot be predicted if you use that inside the equation. In other words, variable A cannot be used to predict variable A. I can't give you an analysis of the markets by saying price A plus price B divided by price C equals a prediction of price A, right? If you look at the amazing calculations done by guys like George Lane to produce stochastics, you'll see that the whole thing's a fallacy. In there, there's A is being used through all this computation to produce A at the other end. Price is being used and massaged and manipulated to predict price later. The whole thing, fallacy. It is a illogical, impossible mathematical relationship. But people have built their entire lives on this, right? That's the assumptive process. Losing traders tend to make assumptions about the meaning behind market-related events or data and how that can help reduce the risk. Market news. How about a price reaching a certain level? Oh, that's the highest it's ever been in recorded history. That's got to be a sell. How do you know that? Are there more buyers than sellers still in the wings? Because if they are, that price is going higher and you ain't going to stop it. Back testing, a new method of technical analysis. Do you know there is no new method of technical analysis? There isn't any. Anything you could think of has been already thought of years and years and years ago. In fact, if you want to read a real interesting comment on technical analysis, you're going to want to read the first few pages of chapter 5 of a book called Reminiscences of a Stock Operator. It was written by a man named Edwin Lefebvre, which was the nom de plume or pen name of a man named Jesse Livermore. And if you don't know who Livermore is, I want you to put everything down that we've talked about right now. I want you to close your computer and go learn who Livermore is before you do another trade or listen to another broadcast from someone like me. If you don't know who Jesse Livermore is and you haven't read anything about Livermore, in my opinion, you're due to be a loser the rest of your life in this business. Livermore was the only trader that mattered for a lot of reasons. Everything that guy talked about, he's the gospel of this business. And I think you should learn as much as you can about him. And one of the things he wrote about in his book, The Reminiscences of a Stock Operator, is how he learned about the fallacy of analysis. The assumption that people made that it would work was why they lost using it. Misconceptions or illusions. These are present in traders' thinking. They affect the conclusion-making process about the meaning of certain prices or certain price action. Misconceptions are manifested in traders by using certain words during the evaluation or assumptive process. In other words, the market should do this, the market should do that. And that's always based on something, should, shouldn't, must, can't. Those words, if you're using those words in your thinking or in your evaluation or in your analysis, the best you're trying to do, if you're using those words, you have a misconception. There's something about your thinking process leading you to believe something that simply is not true about the markets. So here's how it can help you lose. For example, let's say you were watching something looking for an opportunity and the market went to a price level that you believed it should have gone to. Well, that validates the knowledge that you use to make that assumption. In your mind, you're thinking, wow, I did all my paper trading perfectly. And it went from A to B and I would have made a lot of money. Therefore, I'm doing paper trading right. I'm learning how to do analysis correctly. I'm going to make a lot of money. And then when you do a trade the next time and it doesn't work, using all the same data, same information, same analysis, you can't figure out why that happened. And you think the problem is what? My analysis. I must have missed something. No, you didn't miss anything. What you did, you made money because you were on the right side of the order flow, but you didn't see it that way. You thought it had to do with analysis. So the next time you do the analysis, you come to the same conclusion, you put the trade on, you're on the wrong side of the order flow, which can happen at any time because you can't reduce the risk. But you don't understand the order flow is what matters. So you think it had something to do with your analysis, and it didn't. Justification. Losing traders have to explain their losses. This is another expression of the illusion belief structure. Prices can be predicted. The market, quote, went the wrong way, and that loss could have been prevented somehow, which is basically another way of saying my analysis could have been better, so I would never have seen that trade. I never would have put that trade on because I was thinking better. And the critical factor in this thinking, the reason this doesn't help, the reason why justifications won't help you win is because the focus of the justification is always outside of the trader. I analyze the charts wrong. The charts are the problem. So-and-so said something that ordinarily would. Janet Yellen's not even the chairman of the Fed anymore. And she's talking about something and that the market bonds went against me. If she would have kept her mouth shut, I'd have been fine. The news was a surprise. Oh, we never expected that inflation. Gas going to $6 a gallon. When inflation came out, 2 months later, boy, it showed a really big spike in inflation. Never saw that coming. What do you think's going to happen if gas is at $6 a gallon now and inflation numbers come out lagging the market 60 days later? What do you think they're going to say? There's no surprise anything. You see, the trader, okay, since the trader is trying to reduce the risk, meaning gain better control over what's happening in the markets to himself, and the loss happened because of something there was no control over, well, then that explains it. And the fault is not with the trader. So justifications are another losing behavior. Expectations. I'm doing X, so therefore I can expect Y. And this thinking is especially dangerous to the trader because once the expectation is held in the mind, very little other data will be considered or absorbed. For example, let's say that you think the market should be bullish and you do all of your analysis from the standpoint of the bullish point of view. You're going to tend to not look at information that might be bearish. Now, I'm not saying that you're going to be right or wrong based on holding your point of view, but I'm saying an expectation will create bias. If you're biased in your thinking, then you're not thinking clearly. You're not seeing truly what's happening in the market because you have a bias. You're only looking for the bull side, not the bear side. So expectations encourage illusions about market potential. Expectations have to do, well, for example, a new trading system. Let's say you decide to roll all your dough into one big, wonderful trading system that came well documented. Boy, was that guy a good salesperson who sold it to you. Man, he had every objection I could possibly brought to the table. He showed me factual data. I can't wait to try this system. Then you start using it and you're losing. Can't figure out why. Well, you had an expectation. Exceptions, excuses, or blame. Whatever happened, it's not my fault. Well, yeah, it is. Nobody twisted your arm to buy or sell. To get into the market, you made that choice. To get out of the market, you made that choice. But if the losing trader won't accept that reality, he's going to make exceptions or excuses. The loss couldn't have been avoided because of fill in the blank. Losing traders will make this error more often than any other error in their thinking. In other words, the end result of illusions operating the trader's thinking is that I could have reduced the risk, but I didn't. So what happened? What happened wasn't supposed to happen. So there's just simply no way to avoid that loss. Oh, well, guess I'll have to just remember that I got to keep my stops closer if Yellen's going to be talking. Right? Trader doesn't have to accept the blame himself. No, but you do. You do have to accept the blame because you are the problem. So to summarize this, we can get to Q&A. All the various methods of thinking are interrelated and often involve more than one kind of thinking operating at the same time. This is why trading can appear to be so confusing for so many traders. I'm trying to do all this right. I'm making my analysis. It's supposed to work. Technical analysis is not based on the loser relationship. It's based on number crunching, and number crunching is a fallacy. You can't number crunch your way to success in this field, even though people think you can and believe that. But if you do that, and then the trade doesn't work, what happened? Well, I couldn't be avoided. Making excuses, whatever. See, whatever thinking is going on in your head that's involving all this entry-level stuff, this is why it's confusing for you. So the result is virtually no potential for a trader to make consistent gains, because your thinking will most likely lead to placing trades for reasons that have little or nothing to do with actual price potential. Price potential is based on order flow. Where is the loser trading? When the loser gets long, I need to be short. When the winner starts selling, I need to buy. That's the only way to make money, because 85% of them are losing all the time. So if a loser says, I'm getting in on the buy side, that's generally a clue the market's got further to go to the south side. Why wouldn't I be short there? Because it doesn't matter what the number is, doesn't matter what the news is, doesn't matter what any of that crap is, because if the 85% of the market is selling it into the hole and we got even further to go, I should be buying. If the market is ready to reverse because there's nobody left to sell except the last group of losers that got in, how do they get out? They got to use a buy order to get out. So the market's going to have a flood of buy orders as those shorts start taking heat. And those buy orders are going to overwhelm the sell orders, creating price action upward. That's going to make my long successful. That's what you have to think like, not the rest of this crap. Things like waiting for confirmation, advanced analysis. I'm going to wait for the news to come out. These are all attempts to reduce the risk based on assumptions, illusions, misconceptions in the first place. You can't reduce the risk. All of these critical loser thinking processes are the same for anyone facing a failure in any area of his or her life. Our external reality is what it is for us, largely due to how we structure our internal world, our thinking. To excel in anything, we must change and adapt our thinking to the requirements of that success. In order to succeed at selling, anybody who's been in sales for any length of time will tell you, you have to ask for the order. The best salesmen, the people that make the most money selling, ask for the order 5 times or more. When I learned that, I almost died as a salesman. I couldn't believe that. 5 times? I started with hello. Hey, how you doing? Yeah, you want to buy this car? I don't know. Tell me why. We'd have a conversation. Then I'd say, you want to buy? I learned over time that if you ask for the order 5 times or more, people eventually will say yes. And the reason being because they want to buy. They really do. But they got to like you and they got to feel good about it. They got to know they're making a good decision. All those are based on what? Having a relationship with the person, not facts and information about why this 1982 Ford POS is going to work tomorrow. You know what I'm saying? It's important for you to understand that we have to adapt our thinking to the requirements of the success that we're seeking. To trade in the markets, we got to adapt our thinking to the fact that we're not going to win unless we find the loser. So how does all this crap that I'm reviewing every day, how does this help me find the loser? If it doesn't help me find the loser, there's no point in using it. And this is why trading can be so difficult for so many losing traders. They either don't know they must change their thinking to succeed, or they simply refuse to believe they need to think that way. They continue to lose while all the time gaining ever more market knowledge when the real problem's inside of them. See, a wake-up call. This is common to everyone who eventually reaches the success they want, because you can't get there without it. In the markets, the wake-up call is your losses. You'll continue to give your equity to the markets until you address the losing issues currently in your thinking. Once you do, you can begin the process of lasting success. And when I say begin, it's a lifetime process. Now, the reason success in trading continues to be a rare thing for most people is because success at anything is rare for most people. Most people are average, apathetic, and indifferent because they live at an average, apathetic, and indifferent life. You have to raise the bar for yourself. To become a top performer at anything requires that you make choices differently and change what you're doing and keep working at that change until you master what is required to succeed. Most people won't do that in the first place. They want easy money. Part of the reason some people are attracted to the market is they think this is easy. It's the single most difficult thing you can ever do. Roy Longstreet said that successful speculation was the single most difficult thing for a human being to do. And Roy Longstreet was a man who made millions doing this. This is why losing behavior is so common in the markets. Most traders don't possess the ability to learn what is required to win, either by ignorance or by refusal. So that being said, thank you. Consider me your friend in the business. Right now, you get a free sample of my book. Just go to my website, theliononline.com, and click the link that says, thank you for getting the book, and you'll see it. You can get it through Kindle. If you can't get it through Kindle and you want it through like Apple iBooks, it's on Apple iBooks. If you want to get it through another format, just let me know and I'll send you the link where you can download that at a company called Smashwords. In fairness to David, I can't put up all the links, so I'm just putting up the one link. You'll have to go to my site and look for all the free content that I'm going to give you right now. All I got to do is go to my site. I got all kinds of stuff you can download for free. Videos, PDFs, all kinds of stuff that's there for free. Just have a look. It kind of opens up the door to a relationship. Bottom line is, all I want you to do is consider me your friend and maybe I can help you reach some of your goals. But I'd love you to get a copy of my latest book, The Psychology of Trading, How to Create and Maintain Your Winning Edge. Okay, floor is open for Q&A. We've got about 10 minutes, 15 maybe. So let's see what we got here. What we had here. Ricky L says, honesty about your losses is appreciated and respected. Sure, no worries. A. Aronson says, I read that it's a negative sum game. This is higher than even considering a zero sum game. Negative because spread is paid on an entity already, says the author. Okay. Why does that matter? You start with 10 grand. You want somebody else's 10 grand. The fact that you got to pay somebody $1,500 to do that, why is that a problem? Can you give details of the book? What do you want to know? Reminiscence of a stock operator. There it is. Edwin Lefebvre, Jesse Livermore. A. Aronson said, Warren Buffett said, don't lose money. Rule number 2 of money is don't forget rule number 1. Warren Buffett's an idiot. Warren Buffett lost $12 billion of his customer money trading currencies because he wouldn't cut a loss. He believes that as long as you stay in long enough, all tides will raise every boat, right? Rising tide lifts all boats. Warren Buffett is not what you think he is. He's a dinosaur. He doesn't understand zero-sum transactions. He won't open his mind to it because he believes there's only one way to make money: buy and hold. Buy and hold until all the economic realities come back into further congruence. All right. Whatever, Warren. Hope it works for you. What's your advice to me that is self-taught, but I want to be elite? What's your advice to me that is self-taught, but I want to be elite trader? You think for yourself. Stop relying on other people to give you help in this business. You have to think for yourself. Now, that doesn't mean you can't ask questions and get information from other winning traders. What I mean is stop letting people tell you this is how it's done. It's not done. It's done by the way you want to do it. There is no right or wrong way to trade. It's what works for you. Every starting point has one of the greatest Formula One drivers in history, Michael Schumacher, did one thing differently than everybody else. That's why he's the best. And no one could figure out what it was. No one could figure out what it was until they studied him while he was racing. When Ferrari let the information out into the public realm of his winning lap times, when he would get out there and play winning lap, just get out there faster and faster and faster. What's he doing? He's doing the same thing everybody else did, but he was 1/10 of a second faster on it. That's it. He didn't have anything special on his entry. Didn't have any special on his exit. It's just that when the time came for the car to be under power, under load, he was 1/10 of a second with putting 100% of the horsepower on the rubber. That was it. He downshifted and braked it. Downshifting and braking. That's like tying your shoes is to football. Shifting and downshifting and braking is to auto racing, like tying your shoes is to football. What he did for braking and downshifting was identical. He would nothing different. Entries, setups, everything. In lap, out lap on his pit stops, everything. Nothing different. Just 1/10 of a second faster, pushing that right foot to the floor. That's all he did. What's the difference? 7 world championships. Winningest driver in history. Wow. That's all it took? Yep. So what am I telling you? Who taught him to do that? Nobody. He figured it out for himself. Author is who on successful speculation? It's Roy Longstreet. Why you failed in that first quarter you mentioned. Okay, first of all, I don't fail. It's not about failure. It's about results. Failure is a way to label results that you think are not what you wanted. Which means what? Why would you label any result? If you label results, you can't learn from any of them. If I made $100,000 next week, it wouldn't be I made money. No, my results were X. I didn't fail at anything. I don't fail. There's no failure's not in my lexicon. Results. The results were less money on the end of the quarter than I had at the beginning of the quarter. How did that happen? It happened because the character of the markets changed faster than I personally could equate to or personally could absorb. In other words, everything that would normally be workable for me was not workable. Time frames for highs and lows had changed. Money moving into the market and moving out of the market, losing traders were making money when they normally wouldn't be. That means they were building in confidence to do things they normally wouldn't do, which put normally when a market makes a high print, I get short within about 12 hours because there's something going on. Can't make another high. There's a reason why it failed at that high. Oftentimes that was a prelude to another rush to a new high by somebody who normally would never be in that market. There were people trading currencies in Q4 last year that normally wouldn't be there. So the character and quality of the market changed before I could assimilate that. You follow me? That's normal. That happens to everybody. The difference is I didn't blow myself out like most people do because I was, I got to get the money back and all that other emotional stuff that goes on. You follow me? Could you comment on the current condition of the open interest in the ES? No, I have no idea what you're looking for there. What are you looking for there? Pete says, bought your book on Kindle. Thank you, Pete. What is the cost of the book? $9.99. Best $10 you'll ever spend, in my opinion. Jolyn says, thank you. I thought this was a brilliant presentation. Well, thank you. Pete says $9.99. Yes. Aronson, what do you think of entering both sell and buy orders at the same time and trading breakouts? Okay. What you're talking about there is strategy. All right. Strategy is not the same thing as tactics. And you have to understand how to win the war. The way you win the war is by finding where the loser is participating. So when you find out, if you have figured out a way, some way, we could talk millions of different ways, but just for a minute, say you have discovered something that says, hey, wait a minute, that's a strong clue that the loser's on the buy side. That means I need to be a seller at this point. Okay. However you come to that conclusion, that is the war. The war is finding where to sell when the loser's buying and where to buy when the loser is selling. Once you understand that relationship, you're going to discover certain things that have to do with strategy and tactics. Things like 80 to 95% of people doing this on a daily basis are day traders. That means they're going to be flat at the end of the day because they believe reducing the risk means don't have a position on overnight because they're not awake to watch it. Well, it doesn't matter if you watch it, the market, you're not going to control how much order comes in anyway. It doesn't matter what the order flow is. Watching it all day long doesn't make you any better at understanding it. So watching the market overnight won't help you make or lose any money if you're in it. But because you can't watch it, you think that's dangerous. So you liquidate by the end of the day because you think that reduces the risk. Okay. That means if everybody came into the market on the buy side at the open and the market made some kind of a profit for those buyers during the day, they're going to enter a sell order before the end of the day because they have to be flat. That's the definition of a day trader. So if the market is all loaded with buy side action early in the day and it doesn't go anywhere, it's going to slide off by the end of the day. So if you don't see a new high by, say, 11 o'clock, by the end of the day, that market's going to sell off hard because all the day traders are long. They can't get out unless they use a sell order. They're going to sell, all those sell orders are going to bunch up at the end of the day and overwhelm the buyers that are there. That's the game. The strategy would be sell the market at noon when it's quiet. The tactics are, once the sell-off happens, add to the position. Then roll your stop to break even on the entire position, hold it overnight for the rest of the losers in Tokyo and India and New York or London to realize they're going to get their head kicked in, and then you can cover it in the morning with a nice big win. You see what I'm saying? So there is no right or wrong way to do it. There's just what is the strategy and tactics that help you win the war. The war is the same. So what will help you, if you think entering a sell and a buy order at the same time, what does that do? If you say, I want to short this market, but I'm only going to take it off when it reaches this low print down here, what if it's got 100 times more distance to go? Why would you why would you cut your profit short? You see what I'm saying? Al says, agree to G8 presentation. Is your book available in soft cover? No, not yet. The only way it's available is through a secure electronic format. I'll tell you why. And I'm just telling you this because it's the truth. I was approached to write books for Wiley and Son. They asked me, they said, we're going to do a series called Wiley Market, whatever it is. And some of the best traders in Chicago, they went and saw and knocked on doors and said, write books for us. So I was asked to do it. And that was my first one, Trading Rules That Work. I use my psychology and my thinking process to outline some of the best ways for you to put rules in place, rules that will help you stay on the side of the psychology you need to be on, right? Was a bestseller at Amazon, and then all of a sudden, wham, not a single sell. My second book, The Art of the Trade, was released, became a bestseller at Amazon, slam, not a single copy sold. My third book, Time Compression, 5,000 copies printed. It's out of print because nobody bought it to begin with. Oh, it's a lousy book. Wrong. If you go there to Amazon right now, you can't get a copy for less than $300. Why is it? What's the problem? They've all been pirated. You can go onto the web, type in the title of any of my books and say free PDF, go to the second or third page, and there'll be some asshole in China or the Ukraine or somewhere in Nairobi or maybe Lagos, Nigeria, with a server that says, sure, you can have any book you want. All you gotta do is buy our download our software, our $2.50 software, and you can download any of the books you can find. They're free. All you do is buy the software. Someone took my book, scanned it into a free PDF, and is selling it for $2, $3, whatever. Get it for free. Wiley can't protect me. They can't take the effort and work that I put into. I've never seen dime one for any of the books I've written, except this one, which is on Kindle. You can't pirate it. It's next to impossible to pirate. But if you want to pirate it, good luck. What does that say about you? So I self-published the latest one because I wanted to at least try to have a reasonable amount of money come back to me for my effort. So that's the answer to if my book's available in softcover. No, because someone will take it, scan it in, and put it up on some server that's outside the, why do we have this big thing with China? They're stealing all the intellectual property and putting it out there for sale. Drop a bomb on those guys. What other format can I get if I don't have Kindle or Apple? Well, you got to go to smashwords.com and look up the titles, or you can email me on my website is my contact listing. All you got to do is email me and I'll send you the link. Take 2 seconds out of your day. A. Harrison wants to know, what's the closest source to getting insiders info about smart money activities? Okay, first of all, there is no smart money in this business. Really important you understand. Some of you guys have seen big traders out there that are supposed to be the smart money. Bill Ackman got his ass kicked for years, but he's smart money. Hasn't made a dime in the market since, I think, 2019. Loses money every year. But he's smart money, right? There is no smart money in this business. All the guys out there that are trading huge sums of money, their job is to make sure that money doesn't move. In other words, do not leave. This money can't leave our business because otherwise we'll lose our 2 and 20. That's how it works. 2% of $1 billion is a lot of money when all you got to do is put one guy behind a desk, tell everybody what a genius he is, and then have a support staff of people to handle the phone calls when he's losing. That's all it is. That's what there's no smart money in this business. It's important you understand that. There's smarter money. That's guys like you and me, but there's no smart money. What's the email address? Can I type that in there? Okay, here it is. Pete says, if you don't have Kindle, just download on your phone, iPad, desktop, or whatever. It's a free app. Yeah, it is. What else has he got here? It's better to trade with the bigger institutions. Okay. The answer to that is that's because they got the order flow, but they're not right. Warren Buffett is an institution. He's not, he loses more money than he makes, in my opinion. Do you advise traders to trade for prop firms, or is it loser's mentality? Well, okay, there's a big rush out there right now for people to participate in what they're called funded traders. And I did this. I went ahead and did a funded trade. I won't tell you who, but I did a funded trading thing. They have a trading contest. You pass the contest. Then you do a verification contest, pass the verification. Then they give you a chunk of money to trade, and you get a percentage of what you make. I did all that, and it was nice, not bad. But then I started doing things that they didn't like holding trades overnight. Why are you holding trades overnight? Because I want to hold trades overnight. Notice the big move I'm on right now. Well, that's too risky. See, if you're holding trades into overnight session, that just exposes our company to risk. Okay, so what are you telling me? I can't do that? What can I do? Oh, you want someone to duplicate the exact way you participate. How does that benefit me? It doesn't benefit me. Prop firm, fine. Get a job with a prop firm if you can handle the restrictions they put on you. Great. Try to win one of those contests. Could be the best $500. Just instead of losing thousands of dollars to the market, try one of their $500 contests. If you can win the contest, meet the requirements, and they give you $50,000 to work with, you're making money. So it's a great idea, but they're going to try to put restrictions on you. Almost all of them have restrictions. You got to find a prop firm or a funded trader program that doesn't put restrictions on you, or see if you can handle the restrictions that they do put on you. You know what I mean? Ricky says, so do the big institutions do manipulation through the quantity buys and sells or not? Well, okay, first of all, explain to me what manipulation is. Is manipulation forcing the market to go to a price point that it's not comfortable with, therefore it will fall back, and I use that to profit myself or my firm or my customers? Is that manipulation? Or is manipulation forcing the market into a price direction so that I can profit but nobody else can? Is that manipulation? What's manipulation? If I put 100,000 buy orders in there and nobody can take it, that market rockets away, hits the buy stops, and then I sell into that when there's finally some volume and all the buy stops are available for me to liquidate my position on by selling into those buy stops. What is that manipulation? Or is that using the quality of the market as it was there to use? You tell me. I don't think there's anything as such thing as manipulation. I think whatever happens, happens. And if you can take the heat, good for you. If you can't take the heat, maybe you were trading too large, or maybe you shouldn't be in the markets. Because manipulation is an opinion. I'll tell you something about opinion. Well, anyway, sorry. I think I'm looking at the clock here, and David is letting me run a little long here. Thank you. I know we've got another guy after me. Is that correct?
Yeah, he's not here yet, as far as I can see. So, I just let you keep talking.
Okay. So, if you want to, that's fine, guys. If you want me to take a few more questions, I'll be happy to do that. I don't want to infringe on another guy's time.
Yeah, let's give him a few more minutes. If you have more you want to talk about, I think, it's great presentation so far. The audience is enjoying it. So.
Yeah, I learned my lessons from last time, Dave. Is that you noticed I haven't used any profanity today.
I'm actually supposed to report that on the YouTube channel if anyone says certain things. But
I know.
No, I didn't.
I was thinking about it the other day. My wife says, there's a lot of people out there. It doesn't matter how successful you are or how good you are. There's a lot of people out there going to think you're very unprofessional and rough if you use certain words. That's fucking stupid.
We're pretty casual here.
So. Yeah, I know. Anyway, I appreciate you giving me a few extra minutes. Thank you. I promise I'll stay clean and green. But if anybody has any other common questions here, we got one right now. What's the best tool to study order flow in Forex or stocks, etc.? Okay. If I've got another extra minute, because we're waiting on another guy, as soon as he shows up, I got to go. So I'll try my best to be as concise as I can on this. The skills that you need are identifying and understanding who the loser is. What do you think can help you with that? What would be the things that would disclose loser mentality? Now, I'm going to tell you what I do. Some guys listening are not going to like this, but I'll tell you what I do. When I'm ready to start studying where the loser is in a particular market, I join a chat group online that focuses on that market. Maybe I'll use Trade the Markets for their S&P room. And I'll join and I'll just say, hi guys, I'm new. What's going on? I'm a newbie. What's going on? And I'll hear people start chatting and they'll start putting their two cents in there. And then what I'm looking for is a particular kind of person. I'm looking for somebody that's going to tell me forever why the system he works with is perfect, why he trades with, ABC indicators, why he listens to so-and-so, or why he thinks, this analyst is the best, and on and on and on. And then I just start writing down, 9 o'clock in the morning, this guy said, I'll buy the S&P if it rallies to, whatever price. And I look at the price and it's below that price. So why isn't he buying here? So rather than ask, why are you not buying here? Why are you waiting? I'll say, well, it's not at that price yet. What's your plans? He said, well, I'm going to wait because I need confirmation. Confirmation. Great word. Wow. That just says volumes about confidence, volumes about what's going to happen. Confirmation. Here's your confirmation on your rental car, sir. Here's your confirmation on your airline tickets. Hey, we're going. That car's mine. Confirmation on this trade. Wow, that trade's going. And I'll look and I'll make a note to myself. Then I'll look at the 5-minute chart and I'll realize this guy's going to buy when the market's at a 5-minute point of resistance. Typically, there'll be a pullback from there. All right, so he's buying and there's going to be a little bit of pullback if it gets to that price. A 5-minute resistance point. Then I'll look at the 10-minute, 15-minute, 30-minute, hourly, and it's all the same resistance. In other words, that point that he's talking about is, a resistance area for many multiple time frames. And so I'll type in, why did you pick that number? And he'll say, well, on the 5-minute time frame. And I'll say, okay, what other time frames are you looking at? Oh, that's it. I use the 5-minute. That's my 5 minutes what I work with. Okay, so here's what I know. This guy won't buy the market now because he needs confirmation, which is just an emotional satisfaction that he thinks he's going to make money. That's all it is. And he's going to buy at a point where the market should have some degree of selling interest. It's been the same level it's backed away from consistently for the past 72 hours to, 2 weeks or whatever. So a little bit of price pressure there would be normal. So he's going to wait for the market to get there, then buy. So he's going to give up profit potential. He's going to buy into resistance, and he's only looking at one time frame. Okay, there's a real good probability that I could put a sell there, and 65% of the time I'll get a lead. So that's what I do. I put a sell order at the price point that he said he'll buy at. So I'm going to be the guy selling it. So it reaches that price point. He gets long. It goes up another tick or two, and then crashes. And all of a sudden, he's holding a $400 per contract loss. Where's your stop? Oh, I use mental stops. Okay. Did it go through your mental stop yet? I can't talk about right now. I'm busy reanalyzing the markets. Okay. So what does that mean? Well, this is a typical loser. So I write down the guy's handle and I put down the time frame, and I realize this guy, and I check every day now while I'm trading in the S&Ps, I check to see if that guy's active. If he's active, he's a real good clue as to where the loser's going to be. And I'll just put in there, hey, is Bob Z. Callie in here? No, he's not here today. Oh, probably got his ass beat the last 4 days, so I take a day or two off too. Now, I don't say that. What I say is, oh, Well, I really enjoy what he has to say. He's really, really sharp guy. I love that guy. And that's it. And then somebody else will say, oh, well, he goes to see his grandmother on Thursday, so he'll be back on Friday. Okay, whatever. More information is helpful, right? So I call that the loser chat room. I sign into a chat room. I look for a guy who's really vocal, very going to brag about what he does. He talks about himself, what his results are. Somebody who's really out there. And I just kind of follow along in real time. And once I've identified one or two of these guys in that marketplace or in that chat room, I just really take critical notes on the guy. And what I discover is that when I find a loser like this, they're usually good for about 30 to 60 days of time where I can pretty much fade them. And they'll help me get positioned better in the market I'm trading at the time. After about 60 to 90 days, they're not as good because they're panicky. They've lost a large amount of money. And then by the 4th or 5th month, they're gone anyway. So the strategy of exploiting loser chat is an ongoing dynamic thing for me. I've got to find new guys in the chat rooms consistently. I never talk about myself or that I've written books or anything. I don't, or that I've been a trader for 40 years or like, hey, I got short against you at that high print, took your money, haha. I don't say things like that because you get kicked out of chat rooms for doing that. What I say is, well, I really learned a lot by working with you. Thanks for your insight. You know, there's no reason to be, add insult to injury. So that's one way I found I can get a better handle on the loser. When I worked in an office, it was simple. All I do is walk up and down the rows of guys on the phone and listen to them. And listen to what they do and how they justify their trades. And I just had a notepad with me and they were like, why is that guy walking up and down the aisles listening to everybody? Was he with the NFA or something? No, I'm listening to what you're doing in the markets. I'm taking the opposite side. We'd be out drinking and I'd say, yeah, I took your money in copper. You were long copper. I sold it on the rally. Really? You got short at the top? How'd you do that? By listening to you, asshole. You waited for 2 weeks before you got long. Then when you got long, you got the last 2 cents of the move. After a while, I was the outcast in the office and no one invited me to the aftermarket parties because I was taking everybody's money. Okay. That's how you do it.
Hey, Jason.
Yeah.
I think Gary's logging in now. So
Gary's here. Okay, great. Listen, to sign up real quick. Thanks guys for coming. Here's my website. It's on the screen. Thank you, David, for giving me extra time. I'll let you guys do your thing. Before I go, can I just ask you, can I get the recording for this one?